They want you calm. They want you distracted because what's unfolding right now isn't loud, it isn't flashy, and it isn't being screamed across cable news banners, but it should terrify anyone who understands how power actually works in global trade. Canada, America's closest ally, biggest trading partner, and economic mirror for decades, is quietly, deliberately, and very effectively loosening itself from U.S. dependence. And the early results should set off alarm bells in Washington boardrooms and state capitals alike. This isn't a tantrum, this isn't posturing, this is a strategic withdrawal executed with spreadsheets, infrastructure, and cold political math. Prime Minister Mark Carney has just put into motion what analysts are calling the most aggressive re-engineering of Canadian trade policy in modern history. And unlike past disputes that fizzled out after a handshake and a photo op, this one is already reshaping where money flows and where it doesn't. Carney's government has committed to a blunt objective: double Canada's exports to countries outside the United States over the next 10 years. That sounds aspirational until you look at the numbers already rolling in. Tourism revenue connected to Canada is collapsing inside the U.S. manufacturing supply chains are buckling, and roughly a quarter to nearly a third of Canadian exports that once moved south are now being rerouted east and west instead. This isn't theoretical, it's measurable, and it's accelerating. For nearly 3 decades, Canada has sent the overwhelming majority of its goods to the United States. Right now, about 76% of Canadian exports, roughly $430 billion a year, still cross the U.S. border. That trade relationship supports around 2 million jobs on both sides and forms the backbone of North American commerce. But that backbone is under stress. Canadian exports to the U.S. have already dropped by roughly 3% compared to the same period last year. That alone would be concerning. What makes it dangerous is where those exports are going instead. In the same time frame, Canadian exports to the United Kingdom surged by nearly $10 billion. Shipments to the European Union jumped by about $5 billion, a 20% increase. Exports to China rose by more than $1.5 billion. And Canadian crude oil exports to China didn't just rise, they exploded, jumping roughly 240% after the Trans Mountain Pipeline expansion finally came online. These aren't random fluctuations, they're coordinated shifts. International Trade Minister Maninder Sidhu summed it up without theatrics. Canada has woken up to the fact that it is dangerously overexposed to the U.S. market, and that realization didn't come from ideology, it came from tariffs. The trigger was the Trump administration's escalating trade war. U.S. tariffs on Canadian goods climbed as high as 35%, with steel and aluminum facing rates closer to 50%. Ottawa responded with retaliatory tariffs on roughly $20.7 billion worth of American imports. Washington assumed, incorrectly, that economic pressure would eventually force Canada back to the table on U.S. terms. Instead, Canada began quietly constructing exit ramps. Here's what that looks like in the real world. Canadian oil exports outside the United States recently hit a record 525,000 barrels per day. That oil used to move almost exclusively to American refineries. Now it's flowing to Asia. Pipelines have been built, ports have been upgraded, long-term contracts are being signed. Once those systems are in place, they don't get dismantled just because the politics change, and that's the part Washington didn't plan for. Canada isn't improvising. It already has 15 free trade agreements covering 51 countries, granting access to more than 60% of global GDP and roughly 1.5 billion consumers. This isn't a scramble for new partners. It's the activation of trade architecture that existed but was underused for years because the US market was easy, close, and dominant. Europe is the most obvious pressure valve. The Canada-EU trade agreement has been provisionally enforced for years, but it was never fully exploited. Only about 4% of Canadian exports currently go to Europe, while about 70% head to the US. That imbalance is now being treated as a liability. As U.S. tariffs made American buyers less attractive, Canadian producers pivoted. Aluminum shipments to Europe surged. Crude oil exports increased. Canola seed shipments to Europe jumped more than tenfold after China slapped 100% tariffs on that product. When one door slammed shut, Canada walked through another. Asia Pacific is where the strategy becomes more uncomfortable for Washington. Canada is actively repairing strained relationships with China and India, not because of sentiment, but because of scale. China is the world's largest energy importer. India is one of the fastest growing major economies on Earth. The Trans Mountain Pipeline has given Canada the physical ability to move heavy crude to Asian markets without relying on U.S. refineries. For decades, Canadian producers were effectively locked into a single buyer with specialized equipment. That meant price takers, not price makers. Now they have alternatives. Think of it like this: when you only have one customer, you accept their terms. When you build a road to 10 new customers, leverage changes overnight. Indonesia is another piece of the puzzle. Canada recently finalized a free trade agreement with Indonesia that is now moving through Parliament. Once implemented, it's expected to boost Canadian exports to Indonesia by more than $200 million annually. Even before full ratification, exports to Indonesia jumped by more than $500 million, driven largely by coal and agricultural fertilizer inputs. Singapore has emerged as a strategic hub as well, with Canadian exports there jumping more than 60%, fueled by energy shipments and aerospace manufacturing tied to global aviation networks. Defense policy is also being folded into this trade realignment. Canada has committed to meeting NATO's new target of spending 5% of GDP on defense, the highest level of military investment in more than 70 years. This isn't just about national security, it's industrial strategy. Ottawa has loosened export controls on dual-use technologies and joined the European Union's defense industrial framework, becoming the first non-EU country to do so. That opens European markets to Canadian defense manufacturers in ways that didn't exist before. The Middle East is next. Canadian ministers are scheduled for high-level visits to the UAE and surrounding states, targeting energy technology, mining equipment, and infrastructure projects. None of this is symbolic, it's systematic. Now here's the reality check. Canada hasn't escaped U.S. dependence yet. Roughly 70 to 75% of its exports still flow south. This isn't a clean break, it's a transition, but the trajectory is what matters. Exports to Europe are up more than 20%, shipments to Africa are up 18%, Central and South America are up 11%. These aren't statistical quirks, they're early signals of a structural shift, and unlike trade spats that fade with elections, this shift is being locked in with steel, concrete, ports, pipelines, and treaties. These assets will still be there regardless of who sits in the Oval Office. Which brings us to the fallout inside the United States, because it's already visible. Tourism is taking the first hit. Canadians historically account for about 28% of all foreign visitors to the U.S., injecting more than $20 billion annually and supporting roughly 140,000 American jobs. That flow is drying up. Vehicle crossings at the U.S.-Canada border are down nearly 20%. Air travel from Canada to the U.S. has dropped more than 20%. Car crossings fell by more than 30% in consecutive months. 10 straight months of decline. The U.S. Travel Association now estimates a multi-billion-dollar drop in international tourism spending, with losses around $5.7 billion compared to last year. Florida is getting hammered. Northern border states like Maine, Michigan, and Montana are seeing vacancy rates that threaten the survival of small hotels and seasonal businesses. Owners who used to sell out winter months are now staring at 40% availability. That's not belt tightening, that's existential. That pain doesn't stop at tourism. It radiates outward into manufacturing, energy, and agriculture. The sectors Washington assumed were insulated because of deep integration. That assumption is now being stress tested in real time. American manufacturers built their supply chains on the idea that the U.S.-Canada border was functionally invisible. Parts crossed back and forth multiple times before final assembly. Tariffs weren't supposed to exist in that world, but Canada's retaliatory measures changed the math overnight. Vehicles that don't fully comply with USMCA rules now face 25% levies. That doesn't just raise costs, it forces companies to redesign entire production strategies under pressure. Auto manufacturers are already absorbing higher input costs or passing them on to consumers, but smaller industries don't have that cushion. The furniture and cabinet manufacturing sector is a case study in slow motion damage. Even after Washington paused some planned tariff hikes, U.S. duties on Canadian kitchen cabinets remained punishing. Canadian producers who once depended heavily on U.S. buyers didn't wait around hoping for relief. They pivoted toward Europe and Asia, and many of those relationships are now locked in. That means even if tariffs disappear tomorrow, the customers may not come back. Then there's energy, the sector that should keep U.S. policymakers awake at night. The United States currently imports roughly 63% of its crude oil from Canada, amounting to nearly 1.5 billion barrels a year. A decade ago, that figure was closer to 38%. Much of this oil is heavy crude, specifically suited for refineries in the Midwest and along the Gulf Coast that spent billions upgrading equipment to process Canadian grades. Those refineries weren't designed for flexibility. You can't simply swap in oil from Venezuela or the Middle East without costly retrofits and operational disruptions. And yet, Canadian crude exports to non-US markets have just hit a historic high, more than 500,000 barrels per day. China is now a major buyer, capitalizing on Canada's new pipeline capacity and Washington's strategic miscalculation. If that trend continues, American refiners face a future of tighter supply and higher costs. Not because Canada is hostile, but because Canada finally has options. Agriculture tells a similar story. Canadian retaliatory tariffs targeted politically sensitive U.S. goods, including food and consumer products. The results were immediate. U.S. spirits exports to Canada collapsed by roughly 85% in recent quarters, falling below $10 million. That wasn't just about price, it was cultural. Canadian consumers are increasingly participating in what's being described as a Buy Canadian movement. Domestic brands are being chosen deliberately over American ones. This isn't a temporary boycott sparked by headlines. It's a behavioral shift rooted in national sentiment and reinforced by policy. Once consumers rewire habits, they don't automatically reverse them. Trade experts watching this unfold are blunt about what's happening. Analysts tracking cross-border flows estimate that Canada has already rerouted roughly 25 to 30% of exports that previously went to the U.S. That hasn't fully replaced lost volume, but it's cushioning the blow, and more importantly, it's buying time. Time to expand capacity, time to sign deals, time to reduce vulnerability. And that's the long game. Economists at the Peterson Institute projected that sustained tariffs could shave more than 1% off Canada's GDP over 5 years, but those models didn't fully account for how quickly diversification would kick in. What they're now observing is that while Canada absorbs short-term pain, the United States is accumulating structural damage, disruptions that compound rather than fade. Canadian officials aren't hiding their reasoning. Other countries, they argue, see Canada as predictable, stable, and rules-based. That reputation has become an asset in a world increasingly wary of sudden policy reversals. Diplomatic language aside, the implication is clear. Unpredictability has a cost, and Canada is working to ensure it's not the one paying it alone. Foreign affairs officials have framed this moment as part of a broader global shift, away from a single dominant economic center and toward a multipolar trading system. In that environment, dependence isn't strength, it's risk, and Canada is actively reducing that risk. Politically, the standoff shows no signs of easing. The Trump administration has signaled little urgency to negotiate, openly suggesting that tariffs on Canada could simply remain in place rather than be bargained away. That posture plays well domestically. There's no unified business revolt forcing a change in course, and Canada knows it. Ottawa isn't rushing either. Prime Minister Carney has made it clear that Canada won't sign any deal that doesn't serve Canadian interests, deadlines or pressure tactics notwithstanding. In the near term, expect noise rather than resolution. Cabinet ministers will continue traveling. Deals will continue being announced. Rhetoric will escalate. Negotiations will stall. The USMCA review process looms as the next major inflection point. It could become the forum where tensions are addressed or where fractures deepen. If current trends hold, Canada enters that process with more leverage than Washington expects, precisely because it has reduced its exposure. Over the next 6 to 12 months, the risk profile worsens for the United States. If Canada finalizes deeper trade arrangements with India, expands access to EU markets, and cements energy flows into Asia, the assumption that Canada has no choice collapses. And once that assumption dies, so does a significant portion of American negotiating power. Central bank analysis inside Canada already warns that the trade conflict will reshape the economy in lasting ways. But lasting doesn't mean locked into decline. It means reoriented, rebuilt, less dependent on a single market that has become politically volatile. The legal stakes are enormous. A deteriorating relationship raises the possibility of major revisions to USMCA or, in extreme scenarios, withdrawal threats that would plunge North American trade into chaos unseen in generations. Even the hint of that instability alters investment decisions today. Strip this down to its essentials, and three facts stand out. First, Canada is executing a deliberate, well-funded diversification strategy that has already redirected a significant share of exports away from the United States. Second, American industries are already absorbing real losses, billions in tourism revenue, manufacturing disruptions, and mounting energy risks, with no quick fix in sight. Third, the changes Canada is making aren't reversible on a political whim. Pipelines don't vanish. Ports don't unbuild themselves. Trade agreements don't evaporate when administrations change. This is how power shifts in the modern economy, quietly, incrementally, and then all at once. The most dangerous moments aren't when crises explode overnight. They're when systems are re-engineered slowly enough that no one notices until leverage is gone and options have narrowed. What's happening between Canada and the United States right now isn't a headline dispute, it's a strategic realignment, and by the time it's obvious to everyone, it may already be irreversible.